Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
Well, the Q3 2019 earnings season got underway with a seemingly positive start until things turned a bit mixed. We have a lot to talk about here with our research director, Shiraz Mian, who joins me here at the desk. There is a lot going on.
Absolutely.
And we are in the thick of this earnings season right now.
We are.
So let's start with the banks. Let's recap a little bit.
Okay.
We've already talked about the banks reported out of the gate. Some of the bigger banks turned in earnings that topped the street forecasts, but on the flip side, some of the bank shares rolled over as their executives warned that the current lower interest rate environment is likely to hinder banks' net interest margin growth. That's a widely watched measure of profitability. How do you read that?
There wasn't news. The fact that they talked about margins being under pressure for some period of time, this has been an issue with banks for quite some time. In fact, ever since the Fed has been on this extraordinary phase of monetary policy, keeping interest rates very low, and as a result, keeping margins extremely compressed. So there was a fair warning from them, but hardly anyone, in my judgment, in the market was surprised with that. That said, Terry, results from the banks were very good. Mm-hmm. It's always relative to expectations, right? So relative to expectations, these banks did very well. You mentioned some of the big banks. Yes, JP Morgan had impressive numbers across the board. Mm-hmm. Bank of America had very good numbers, and many others of the regionals and the brokers as well. The proportion of these companies beating EPS and revenue estimates has been off the charts. And
I'll get back to that too.
Okay, yeah. So the stock market performance is a function of what the stock market is expecting when the earnings release come. Expectations were low for these guys. They blew past them. That has to count as a positive and as a goal for these guys. And I'm giving them full credit.
All right, so as far as guidance in general, what role is guidance going to be playing for the rest of the reporting period?
Very important. Guidance is always the most important component of an earnings release because remember, stocks are forward-looking mechanisms and the stock market is trying to price in what's coming, expected to happen in the next 6 to 12 months. So guidance is always important. It's even more important this time because there was this lingering fear in the market, given all these worries about trade and global economic slowdown and Brexit and whatnot, that these companies would overwhelmingly guide lower. That has not happened, and that's actually another positive aspect of the Q3 earning results thus far. That guidance, when it's weak, it's about in line with what we have been seeing. The proportion of companies guiding lower is about in line with what we've been seeing over the past couple of years. So guidance is way too important. It has been and will continue to be this earnings season.
At the beginning of the earnings season, you said overall earnings are at best average. I read that in one of your commentaries. In today's commentary, though, 1024, you reported that growth is weaker, but more companies are beating estimates. You just alluded to that.
That's right.
Right, a minute ago. That's what makes the picture kind of a mixed one, as far as
Fair enough.
I can tell. And generally, revenues have been better than expected. So that said, let's take a look at the scorecard that we have up to now.
Yes. So let me share this slide here. This is as of October 24th. Obviously, 1/3 S&P 500 members have reported results already. That's 169 S&P 500 members. 0.2% is the extent of the earnings growth for these 169.
Okay.
And 4.2% is the revenue growth. 80.5% are beating EPS estimates. 62.7% are beating revenue estimates. As I mentioned in this bullet point, margins are down for 7 of the 16 Zacks sectors, including finance and technology. Earnings growth is weak relative to other recent periods. Revenue growth is good, and a bigger proportion of these companies are beating estimates. I have this one other slide, Terry, where I'm putting the growth picture that we are seeing in Q3 relative to what we had seen from this same sample of companies in other recent periods. And as you could see, the right side, the orange color, is showing the revenue growth performance. The left-hand side chart is showing the earnings growth performance. There's not much positive that one could say about earnings growth, but the revenue picture is looking pretty good.
Well, still, we can't lose sight of the fact, as we've discussed here before, you and I, that companies are being rated on a very low bar this earnings season. Companies may have an easier time jumping over that low bar because it's at a lower ebb. So anything above that's going to look great. Are investors going to be getting a skewed view of company performance because of this?
Folks, Terry is super skeptical in today's session. So I have a chart, Terry, that confirms your skepticism. 80.5% are beating EPS estimates. That's the left-hand side chart. And you could see that's towards the high end of the last 12 quarters. Revenue beats are 62.7%, and that also is at the high end. So these high beats percentages are driven by what you're referring to.
Okay.
That expectations were low. Companies are finding it easy to beat those estimates. But we shouldn't make light of that fact because the stock prices are driven by what the stock market investors are expecting. If expectations are low, this means that they expected a weak underlying business environment in that period, and that weak underlying business trend was expected to continue in the coming periods as well. If actual results turn out to be better, as is the case over here, that's good for these companies, that's good for the market. I don't see that as a negative. As I mentioned earlier, there was this fear in the market, given all the global worries, that we're going to have an overwhelming flood of negative guidance. That is not happening.
Okay.
This is not the only reason this above average proportion of companies beating estimates. This is not the only reason why stocks are higher in response to the Q3 earnings results. The absence of the flood of negative warnings about Q4 and beyond is the bigger reason.
All right. And I guess adding to the mixed picture that I talked about at the beginning, we've also seen some big misses on the top and bottom lines, Twitter being one of them.
Oh, sure. Yeah, Twitter, there's no shortage of those companies. eBay had weak growth trends kind of along the same lines as Twitter. Alliance Data had weak numbers, particularly on the guidance front. Hasbro had weak guidance. Ford Motor Company had weak guidance. When I say there has been the absence of the flood of negative guidance, I don't want to come across suggesting that there are no negatives or there are no companies that are underwhelming results and weak results. So yes, there have been companies that missed estimates. McDonald's was a famous one.
Yeah.
And
these are big companies.
These are big companies, and the market is adequately giving them to the side and giving them the proper treatment.
Yeah.
So,
Yeah.
so the many others where the fear was more prominent, industrial side, particularly financials, the basic materials, we haven't seen those flood of negative guidance and pre-announcements from that area. And that has to count as a positive.
All right. So we're talking here, as I said before, on the busiest day of the reporting cycle, October the 24th. The word is that the tech sector is expected to have a double-digit decline. What's driving that?
That's correct. Yeah, about 11% year-over-year decline in tech earnings. A big reason for that is what's happening in the semiconductor space. We saw Texas Instruments report weak results. Prior to that, Micron. Though thankfully last evening, Lam Research had good numbers. But I have a slide that I want to share here, which focuses on the performance of so this slide is showing kind of a big picture view of what's happening with the chip space. And the semiconductors account for about 1/6 of all tech sector earnings. So you could see the highlighted bar here for Q3 is showing 34.7% decline year over year for the chip industry earnings. And when 1/6 of your, an industry accounting for 1/6 of your earnings is doing this bad, then it's hard for technology as a whole to do better. On top of this, a number of prominent companies like Apple, for example, like Alphabet, the Google parent, they have tough year-over-year comparisons. If we didn't have this chip industry drag on the tech sector, then the decline, there would still be a decline, but the year-over-year decline would be about half. It would be about in the mid-single digits. So this is the primary driver. And as we show in this slide, this is expected to continue in the fourth quarter and only start improving in the first quarter of next year.
All right. Well, the stock market has shown resilience in the face of any negatives that have come out so far during this reporting cycle. Any sectors out there that might show signs of resilience as well?
Sure. So we discussed financials earlier. Among the smaller ones, I would say construction results have come out very well. Even the economically sensitive industrial and basic material areas, those results have come in better. And that, again, goes back to the point we were discussing earlier. Better than feared is, I guess, a better way of putting that than the actual results. I just want to add one other slide before we wrap this up. This is the big picture for the overall earnings picture. And as you could see, Q3 as a whole is now expected, when we blend what has come out with estimates for the still to come, 3.7% decline for earnings and 4% revenue growth. The expectation for Q4 is for a modestly negative growth as well. And then we turn positive in the first quarter of 2020. So it's cloudy right now, but it's a lot sunnier and warmer next year.
You keep bringing that up every time we get together.
That's right.
The eternal optimist.
That's right.
All right. Well, thank you for that. I'm sure we're going to be getting together a few more times before this all wraps up. Don't forget, there's always Shiraz's commentary that you can take a look at, his written commentary on Zacks.com. And most days you can access it right off of the homepage. Also, here's something else that you may want to consider. For a limited time, you're invited to follow market insights, buys and sells from all of our recommendation portfolios here at Zacks in real time, only for the cost of $1. You can even look at services that have up to now exclusively been closed to new investors and reserved just for investors. And all you have to do to access all of that is visit Zacks.com/promo for more details. In the meantime, with Shiraz, I'm Terry Ruffalo.